Hey Eric, how you doing?
Hi, Graham.
I want to talk about stock market crashes because it's October. You know why,
No, why October?
right? Well, there's an article here in Money Week,
Right.
and it reminds us that October is the month for stock market crashes.
Okay.
Let's look at the history. They go way back. I mean, the most famous was, most recently in 2008, which happened in September.
Okay.
But if you go back to Black Monday in the 90s and the 80s, these are all in October, and go all the way back to 1907, the Knickerbocker crisis, as it was called on Wall Street.
Mm-hmm.
Again, it was October. So before we talk about what the importance of this is why October? Have you got any ideas? What's going on in October? What forces all these crashes?
I have no idea. Maybe, there's the last quarter of the year. Maybe that has something to do with it. Or companies realizing they're not going to make their end-of-year targets and then stock prices plummeting. I don't know.
Yeah, I think it's probably something more fundamental to the human being, isn't it? October, summer's over for sure. Sometimes in September you get a warm September.
Mm-hmm.
October, summer's over. It's like, okay, right now, time to get serious. I don't know. It's just a theory. Anyway, I guess the point is that there's a lot of press about stock market crashes.
Yes.
And people get worried about this stuff, right? And they say, the stock market's going to crash, and some guys come out and they say the stock market's going to crash every year. And they're going to be right? Once. So people will sort of get panicky about all this. And for a good reason, obviously, because there's a history. But the point is that what does that mean to us? Do we pay attention? Do we get worried about the state of the stock market? Is it important? Does that mean that our portfolios are going to get wiped out? Should we be sitting there like tracking the Dow Jones on a daily basis and wondering when to bail out of the market? What do you think when you hear these kind of stories and people saying, but it's all very well investing in property or real estate, but the stock market's going to tank? How do you deal with that?
Well, stock markets tanking is actually good news for property investors in general, because we're usually less affected by stock market fluctuations if we're in property, because we've got cash flowing assets, right? We've got buildings that are generating rental income. And of course, I'm worried about people talking about this because it means that they have a financial strategy for themselves that's depending, I guess, on the stock prices. And it's more or less trading, right? If you're monitoring the stock market on a day-to-day basis, that means that your investment strategy is based around the fluctuations in this market, and it requires you to actively monitor this. And that's why I think, property is so nice, because the underlying assets that we own are buildings. And yes, there's also fluctuation in those, right? It's like the stock market, they're less volatile than the stock market, but housing prices go up and down as well. And that doesn't affect us that much because we've got rental income from those assets. How do you look at it?
Yeah, like you say, I think the key here is looking at the income coming from the asset, right? So even if a stock market was to crash, even if the economy was to pit out at 2007, 2008 levels, we're still left with the fact that people need a place to live, right?
Yes.
That won't change. Okay, they may have less money to spend on rent, but it's not like they can defer payment of rent. It's not like they can not pay rent. It's not like they can not live somewhere, right? If a stock market was to crash and the economy slumped, then that would impact car sales, or it would impact spending on vacations, right? Or buying a new iPhone. These things are arbitrary in a way, but housing, having a place to live, you can't sacrifice that. You can't not do that, right? So the point is that, okay, stock markets may go up and down, and housing prices may go up and down as well, but people will always have a need to live somewhere, right? We haven't kind of worked that out yet. We still don't have an app to fix that. And that's the way that it is that, that's going to be the same, 100, 200, 1,000 years from now, maybe?
Right. Absolutely, yeah, I think so too. And with stocks, there's another thing, right? Which is that if you invest in stock, you can't really leverage, right? So you can't invest $1,000 and then borrow another $3 to do the same thing. While with what we do, we can buy, $100,000 asset for, well, depending on, what the bank will allow you to do, but let's say $25,000 or $30,000 down, right? So you can borrow 70% or 65% at least of what you're buying. Well, with stocks, you have to put in 100% of your own cash. It's interesting. Yeah. It's so funny that you bring this topic up because 3 days ago, I think I went through my bookcase and I found a sealed book, and I forgot that I bought it. It's a Tony Robbins book. It's called Unshakable.
Yeah, I have that.
It's very funny because he wrote this other book, which is called Money Master the Game, which is a 400 or 500 page Bible on
It was a monster.
How you should, conservatively invest in the stock market. And then he thought, okay, nobody's going to read that, so let me write a 200 page version, which he did. Yeah. But the interesting thing about it is what really caught me is what I like about it is he says, look, if you don't want to do too much work, and if you want to have a safe way of doing it, basically he says, invest in index funds that have low fees. That's really his advice. And there's a few interesting things that come out. First of all, he says, the fluctuations in the stock market have always been there. But if you look over the long term, the trend is upwards always. And he's advising, do not go in and out of the market. Do not flee when there's a bear market. Do not get overexcited when there's a bull market, when the stocks go up more than 20%. Stay the course, invest in index, and you'll make, well, his prediction is somewhere between 8 and 10% a year, and then you have compound growth, of course, if you keep reinvesting your profits. But I think half of his book is about do not get scared. Understand that these trends in the market are normal. They happen all the time. And 9 out of 10 times out of a bear market where the stock plummets, it will recover. And then he has the statistics, it may take half a year, might take a year, but they will come back. So don't worry, stay the course. And that's, I guess, if you want to look for a way to invest safely and steadily, that's fine. But I think what we're trying to work on is how can you, with the money that you have, build the maximum amount of passive income. And that's not going to work for you if you do this in stocks, because you can't leverage, right? You can't borrow 3/4 of what you're investing on top of what you're investing. That's not possible.
Yeah, there's some key points that I just want to bring out that you've mentioned. The first one is about leverage. And there's a big difference. We talk about this in the book. There's a big difference between return on investment and return on cash. Right? Because most investors talk about return on investment. How much do you put in? How much do you get out?
Yep.
Whereas return on cash is how much cash do you put in? How much cash do you get out? Which is a big difference, because with stocks, as you say, it's simple. Return on investment and return on the cash are the same. Mm-hmm. But with property, return on cash is much bigger because you're also getting the bank's cash, right?
That's right.
So that's one thing. That's all explained in the book. That's technical, but that is what a lot of people don't understand when they look at real estate, right? Is that they don't understand there's a difference, and that's why they compare like for like. They look at stock and they look at real estate and they say, oh, well, stock 8 to 10% a year, that's pretty good. But if you know the real story, check it out in the book. The other thing as well, you talk about not, getting out of the market, which is really important. There's an old saying in investment, which is bulls make money, bears make money, and pigs get slaughtered.
Yeah.
So it's the pigs are the greedy ones, the ones that are fearful as well. They go into the market at the wrong time, chase the trends, and they bail when the market drops, right? Mm-hmm. And I think it explains in that book that, crashes come. They're cyclical, right? They're going to come. Maybe not this October, but maybe next October it's going to happen. But if you stick it out, you'll make your money back. And I think the last point as well is like stocks versus property. I don't think that you should consider one or the other, right? It's a key point, is that you should do both, and I do both, and you're involved in both, right? I think the point is use property as your financial base because that generates the income, but stocks are something that you can probably be a bit more speculative with, right? But that's not necessarily going to get you the financial freedom that you want. So I'd say it's not stocks or, it's stocks and, but treat them in different ways.
Yeah, completely agree.